fundsupermart.com.
Hello everyone. With us today is Joep, the Senior Investment Manager at ING Investment Management, and he is going to share some of his strategies in investing in Asian hard currency bonds. What are some of the factors driving the performance of Asian hard currency bonds?
Yeah, if you look at Asian hard currency bonds, then it's important to realize that the majority of this market are corporate bonds. More than 50% of the universe are corporate bonds. And what are driving the returns of corporate bonds? Obviously, the fundamentals of those corporates. In the end, you get a higher yield than you get in treasury bonds if you invest in Asian bonds. And that higher yield for the corporate bonds is a compensation for the default risk in the end. Fortunately, the default rate has been extremely low in Asia. Last year, none of the rated companies defaulted. And in the previous years, the default rate has been extremely low in Asia, and much lower than it has been in the other regions in the world. So the fundamentals are quite good, and that's a positive driver for the returns in Asia. And the second impact is the technical situation. As I mentioned, if there would be a breakup of the Eurozone, for example, not our base case, but if that would happen, that would result in a deterioration of risk appetite, investor sentiment, and that would impact the market as well. So that's the second driver, risk sentiment, global risk sentiment. Then the third driver, because this is a hard currency asset class, which means the bonds are denominated in US dollar, the returns are also impacted by the movements in the US Treasury rates. So that's the third driver for returns. So first of all, fundamental drivers. Secondly, the technical drivers, risk appetite. And thirdly, movements in treasury rates.
Which countries and sectors would you favor?
Yeah, some countries we definitely favor are Indonesia and the Philippines. Those countries have shown clear improvement of fundamentals. That's reflected, for example, by the debt to GDP ratio, but also by an increase of FX reserves. And we clearly see improvement of fundamentals in those two countries. So we like the sovereign bonds issued by Indonesia and Philippines. In Indonesia, we have seen that improvement being reflected by an upgrade by the rating agencies from a high yield rating to an investment grade rating recently. And in the Philippines, we expect the same to happen within the next 12 months. So we like sovereign bonds in those two countries. If you then look at the corporate bonds, which is an important part of our market, corporate bonds in Indonesia, we like them as well. A lot of the corporate bonds from Indonesia are coal miners, and the outlook for that sector is quite good. Another market we like is Malaysia. Malaysia is the only economy in the Asian region which is an oil exporting economy, so they benefit from the relatively high oil prices, whereas the other countries are oil importing countries, so they are vulnerable to increasing oil prices. So it's also a kind of a natural hedge to have an overweight to Malaysia against a rise in oil prices. Then the countries we don't like at the moment, one of them is where we have an underweight is India. India has a relatively weak banking system. Credit growth has been relatively high in the past couple of years. That resulted in relatively poor asset quality on the asset side of the banks. So the banking sector is relatively weak. At the same time, growth is slowing down rapidly. Especially the last reported GDP number of 6.1% came down significantly from the previous number. Inflation is still relatively high, and the country faces a twin deficit. So a lot of fundamental reasons why we are a bit cautious on India at the moment. Sectors we like at this point of time, oil and gas sector. If you look at the oil and gas sector in Asia, the production costs are relatively low compared to production cost of oil and gas companies in the oil parts of the world. At the same time, the fundamentals, the financials of those companies are relatively strong, and especially the liquidity is high. So from a fundamental point of view, we like that sector very much. And finally, another sector we like is the financials. And especially, I mentioned the financials are relatively strong in Asia, with the exception of India. Within the financial sector, we like subordinated bonds issued by financials. Those bonds provide investors with an attractive yield, and given the strength of those banks, we are prepared to go down the capital structure, so buy more the subordinated bonds rather than the senior bonds, because we believe the fundamentals are strong and you're compensated generously for the additional risk there.
So which of them would you avoid?
Well, not that many. We try to avoid more on a company level. Companies which are dependent on more on exports rather than on domestic demand within the Asian region, exports to developed markets. So those companies we try to avoid. And then one obvious sector we try to avoid at this point of time, but it's relatively small within our universe, is the shipping sector. That's more a global phenomenon. Overcapacity in that sector makes it well, a sector with poor fundamentals. On the other hand, in the Philippines, the corporate sector is mainly, it's more diversified market from a sector point of view. And many of those bonds are held by local investors who have home buys. They like their own bonds and are prepared to buy them at a relatively low yield. So from a valuation point of view, the corporate bonds in the Philippines are not that attractive in our view.
Finally, what are your advices to investors who are keen on investing in Asian bonds?
Yeah. I think for investors it is important, as I mentioned before, to realize that this is mainly a corporate sector, which means if you invest in this asset class, you have a lot of companies to choose from, and therefore it's also a relatively labor-intensive asset class to analyze and to cover. The good thing about that is that not many people in the world have the resource or the time to research this asset class. We believe as ING, with 5 people dedicatedly focusing on Asian corporate credits, we believe we are able to analyze that market better than most of the others in the region. And that has allowed us, and we believe that will allow us in the future, to outperform the rest of the market. Another thing to take into account, because it's a corporate asset class, is that you have a lot of corporates in this asset class. In Asia, corporate governance is weaker than it is in the developed markets. And therefore, it's generally less predictable if negative news comes out from one of those corporates. And for that reason, we believe it's important to diversify your portfolio.